Credit insurance is simply protection for the company's accounts receivables. So when you evaluate a client's balance sheet, where do the ARs typically fall? They typically represent about 40% of the assets, right? And sometimes, in some cases, even more. This is one of the most important assets to a business, providing cash flow to the operations and helping them stay competitive. Quite often, clients just don't realize that insurance is actually available to protect their ARs. The credit insurance policy is triggered in the event of bankruptcy or 90-day delinquency of payment of their customers. So it can give them peace of mind that they will be paid for what they sell. Cha-ching! Any company that sells to other businesses on short-term credit terms can benefit from this coverage. Examples include manufacturers, wholesalers, distributors, and service providers. Businesses that sell products or services directly to customers are not eligible for this coverage. The cost of this insurance varies by type of industry and strength of financials, but the baseline rate is near 1/4 of 1% of insured sales. So I had a client who acted as a manufacturer and wholesaler. And because they relied on their retail customers to move products and repay factoring costs associated with making the product, they were a prime candidate for credit insurance. To help them establish the policy, we first evaluated what amount of loss would seriously hurt the company's financial stability and how many accounts were over this amount. They identified their top 10 accounts, which represented $2 million in sales volume, which we refer to as the insured sales. Then we established a policy limit that represented the typical amount of one account, which was around $300,000. The client was in a riskier industry, and the rate was set at 0.006 of insured sales for a premium of $12,000 per year. Soon after placing the coverage, one of their retail accounts filed for Chapter 11 bankruptcy. An order valued at $270,000 had been shipped, and now there would be no payment coming through. The client filed a claim and recovered this amount from the carrier within 90 days. This is a typical waiting period which allows the carrier to step in and try to collect on behalf of the client. Every business should have a strategy in place to manage bad debt losses, and credit insurance is definitely something that should be discussed with an insurance broker. Even if the client never has to file a claim, they can at least expand their sales confidently, knowing that they have this backup.